Good morning and welcome to this Wednesday, October 13th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, got a big inflation report out this morning, which was still fairly tame. Headline number was slightly higher. We're going to talk about that in just a couple minutes. Also, JP Morgan and some others kicking off earnings season this morning. Big beat by JP Morgan on the bottom line, $3.74 versus $3. I think that's probably going to be some things to come in terms of the banks. This is a group that's been performing really well. The fundamental picture has certainly improved for the group. And even those maybe that don't beat expectations may raise guidance simply because of the improved outlook with yields, Treasury yields. So going to see how the market reacts. Currently, futures actually look pretty decent, or they did. Let me see what we got here. NASDAQ still holding on to gains. Actually, we have turned red on the Dow and on the S&P. Let me give you the latest because that's probably about 10 minutes ago. So currently, the QQQ is currently up 0.22%. The Spider is currently down 0.2%, and the Diamond's down 0.8%. Honestly, not a bad reaction. I was really worried about this morning with inflation, if the inflation data was higher than expected, maybe taking another gap down. We'll see how we open up this morning. But as we pointed out in our Max Payne session last night, for the first time in many, many, many months, I can't remember the last time, Max Payne actually is higher than current price. Normally, what we're looking for is a pullback into the Friday options expiration, because normally we're in an uptrend or we've been trending higher. And as a result, there's a lot of in-the-money calls, and we expect maybe the S&P and the QQQ to pull back. But that's not the case this month. We actually have Max Payne above current price, not by much, but a little bit, fractionally, I think, on the S&P 500. So we'll see how that translates through the action the rest of the week. But at least, the start this morning, I think with the earnings coming out, looking pretty decent so far. And then with the inflation data fairly tame, I think the market's set up maybe to rebound, but we got some big levels to clear. We're going to talk about all of that as we go through the show. But first, let me take you all over to Earnings Beats. If you are new to Earnings Beats, we'd love to have you sign up for a free membership. That's in the form of our EB Digest newsletter. All right, there we go. So if you scroll down, you go to earningsbeats.com, and then scroll down, you'll see this area right here. Subscribe to the free Earnings Beats Digest. You got name, email address, hit that subscribe button. No credit card required, comes out 3 times a week. We'd love to have you. Usually it's a very quick read, just a couple of paragraphs. And a lot of times it's a trading candidate. If you're interested, by all means, obviously the risk is yours, but we just provide information, bring some things to our community's attention. And then what you do with it certainly is up to you. Saturday, we've got Chart Fest coming up. And we're all locked in here, ready to go. Saturday morning, 11 a.m. Eastern. Grayson Rose, the Vice President of Operations at Stock Charts, and Dave Keller, the Chief Market Strategist at Stock Charts and also the host of the Final Bar. Both of them will be joining me on Saturday. We're all going to be going through our routine and essentially how we use charts and the technical analysis and the platforms between Stock Charts and Earnings Beats. But it's completely free. And so another reason why you might want to consider subscribing here is that we're going to be sending out room instructions to our entire community, which includes our EB Digest subscribers. So that information will be sent out on Saturday morning. We'll give you room instructions. You can just come right in. So we'd love to have you. So if you're not already signed up, that's another great reason to be part of our community, is when we do these free events, we reach out to our entire community. Provide the room. Not only that, but if you can't make it on Saturday, we'll send you a copy of the recording that you can view at your leisure. Generally, they're time stamped to give you some information, where you can zero right in on different areas of the recording to try to hopefully save you some time. anyhow, check all that out. Again, go to earningsbeats.com, sign up for our free EB Digest. We have a paid service, but it's free for 30 days. It's our no-cost 30-day trial. This is a great time to come in. And the reason I say that is in a month, it's going to be right in the middle of our fall special. We have specials for membership twice a year, spring in May, and then again fall in November. And so if you take out a 30-day trial, literally your trial will expire right during the middle of our fall special. So you'll get the best opportunity to extend your membership if you're interested. And we've got a lot of great events coming up too for our members. So check all that out. Let's move on, show you what happened on Tuesday. We got the Dow Jones Industrial Average down 117 points, S&P down 10, NASDAQ down 20, mid caps up 15, small caps up 4. So we did get a little bit of outperformance by mid caps and small caps. We haven't been seeing that a whole lot of late, especially if you look back over the last 3-4 months. You can see both these indexes fairly flat, while the others actually had been trending higher. So getting a little bit of a reversal. And honestly, when we get the yields rising or when they start to rise, typically mid caps and small caps do better. And the reason for that, there is a reason, and I think it's somewhat common sense for me as I look at it, is that when yields are rising, folks are moving out of bonds. It generally means the economy is strengthening or expected to strengthen. Well, that fits right into the hands of small cap stocks. They don't have global operations. They're only here in the US. So when things start to strengthen here, you tend to see outperformance by small caps, mid caps that do the majority, all or the majority of their business here in the US. Moving on to the sectors, you've got real estate up, leading the market to the upside 1.3%, but you can see some overhead resistance here at the 20-day. We're going to have to try to negotiate that. Consumer discretionary, which I continue to believe is going to be strong here in the fourth quarter. I like what's been taking place on their chart, not only on an absolute basis where we saw a breakout at the end of September, but also on a relative basis where we've seen a breakout of a relative wedge. So I think discretionary is poised to go higher. Watch for that next breakout. I think if we get another breakout, especially if the S&P climbs back through that 20-day moving average right here, we're trying to get through, I'd say close back up above about 44.50 with the XLY breaking out to new highs. That would be a very bullish combination for that group. Utilities also up, another defensive group. So that's real estate and utilities. 2 of the 3 leaders yesterday were real estate or were defensive. But utilities, like real estate, both struggling to get back through the 20-day as they downtrend. A little different than what we see here on discretionary. The weakest group, communication services, it has struggled since topping at the beginning of September, been straight down. This was a group that was leading, though. So this is what's been going on throughout 2021. All of this rotation. You lead for a while, and then you lose it again. Then you lead again, then you lose it again. That's kind of been the theme. Right now, XLC is losing it. Been downtrending now for about 6 weeks. Another 1% yesterday, or nearly 1%. So got some work to do there to try to get back to the upside. So we're going to need some help from areas like broadcasting and entertainment, internet stocks, especially publishers. Those types of companies are what we find in the communication services group. Finally, from an industry perspective, gambling stocks starting to move back up again. This was the best performer in the discretionary area. And I think we got a triple bottom in play. And if we break back up above 900, that would start the higher high, higher low. That would give us the next higher high, which I think would be really important. So I'd be watching that level on the gambling stocks. All right, moving on. Let's see. Let's go and take a look at that 10-year Treasury yield. So as I mentioned at the open, the September CPI came out this morning. It was up 0.4%. The expectation was 0.3%. So we came in just slightly above expectation there. August, by comparison, was up 0.3%. So we went up a little bit from August and also a little bit up from what the expectation was. The core CPI, however, came in at 0.2%, which was exactly what the market was expecting. And that's really what the Fed focuses on. So I was actually pretty pleased not seeing another huge spike in that core CPI number. So 0.2% coming in right in line. August, by the way, was up 0.1%. So we did see a little bit more, a little bit move to the upside, a little bit move higher, I should say, to the upside from August. 10-year Treasury yield currently, basically it's flat, almost right where we closed yesterday, up just a little bit more than 1/2 of 1 basis point. So really flat. Still up near 1.59% though, still in this uptrend, still above the rising 20-day, still in this pattern of higher highs and higher lows, which was established. I mean, I guess we could say it was established back at the double bottom in early August. Got a higher high, higher low, consolidation, higher high, and now definitely making these moves to the upside, which favors financials. As you can see right here, financials relative to the S&P doing well. And then industrials normally do well when yields are rising. We're finally starting to see a little outperformance there. But now we've got bank earnings coming up, and that's going to be the spotlight throughout the balance of the week. We just had JP Morgan report. They came in at $3.74 versus $3 expectation. FRC, another bank, expected to come in with $1.83. They came in at $1.91. So watching the reaction to some of these banks is going to be really important, because if we start to set a pattern where when they report they go higher, we want to know that as we look later into the earnings season. All right, let's move on to talking technically here. I wanted to talk about the S&P 500 a little bit. So here's the 3-month hourly chart, and you can see here's your top right up here, end of August, early September. We topped up near the 4540 area. We have been downtrending ever since. We took the steep drop back on the 20th, 21st of September. We bounced back, but then we went right back down, put in a lower low. And even with the recent bounce to the upside before earlier this week, we still put in a lower high. So we have this pattern that's still in play in the short term. So this is a 60-minute chart. This doesn't mean we're in a bear market. This doesn't even mean we're in a correction. It means that we're consolidating. We're seeing some profit taking. Most of it occurred during the month of September, as you can see right here. That's when the market tends to be weak. It's the weakest month of the year historically. So I think the market kind of was just playing along with a lot of its seasonal patterns as it weakened throughout September. And now here in October, we've actually shown a little bit of strength, pulled back the last 2 days, but I'm going to be very interested now that we've got the CPI report behind us. It's going to be interesting to see whether or not the market can sustain a move to the upside. As I mentioned, we've got bifurcated action in the pre-market. NASDAQ 100 looks to be moving a little bit higher, while the S&P and the Dow are both very slightly lower. We had futures up overnight, so things have changed, moved a little bit more negative, but still, like I said, holding on to some gains in the NASDAQ. So we'll see whether or not we can open up the QQQ. I'll pull up here as well. And you can see the downtrend here. And I think the downtrend here is maybe even a little bit more pronounced in terms of a channel. So, I mean, I'm just kind of gazing along here, but I mean, something like that might not be exactly the same angle. No, it's not exactly the same angle, but you can kind of get a feel. I mean, if I just drag it down here, you can kind of get a feel for this little channel that we've been in. So where do we want to go on the NASDAQ, the QQQ? When am I going to start feeling pretty good about things? I think if we break back up above about 366 on the QQQ, that's where it will start to look to me like we've put a bottom in. Because at that point, we've got gap resistance here, which we tested and failed. We also would be breaking out above both these highs. So now that would be a nice price breakout in the short term. Also, clearly, it would be breaking this downtrend and down channel. So that's going to be step number one for me, is we've got to get back through 366 on the hourly chart. So what does 366 look like on the daily chart? Well, 363.5 is the 20-day. So if you get up to 366, you will have cleared the 20-day EMA. So not only cleared some key channel resistance and price and gap resistance on the hourly chart, but also taking out the 20-day on the daily chart. And so what I would be looking at when I look at these charts and I think, okay, we're in a secular bull market. That's my big picture theme, is secular bull market. What I think about is looking for continuation patterns when I see weakness like this. And so there are a couple of things maybe to look for. We could have seen this as a left shoulder, this back up as a neckline, this back down as the inverse head, and we could make a run for this 372 level to put in the right side of the neckline, or 374, somewhere in that area. So let me annotate this and just kind of show you what that would look like. So right here, if we consider this the left side of a neckline, then we would come over here. What we'd be looking for is basically something like this. So within the, we're gonna have a little bit of a pullback here, but basically something like this, moving up to test this line, and then maybe one more pullback coming back down. Just grab this and put this, something like that to test this left side low. And then from there, I mean, who knows, but maybe we're going to do that, or at least maybe something like that. That's one pattern. So again, I'm trying to look visually at the chart at what I think could transpire. And if you look over here, we had a very similar type situation. So if I, this was back in February into early March. There we go. So right here, if you look, you'll see pretty much the same pattern. Here's that A, B, C correction, A, B, C correction. The move back up goes through the moving average. That's usually a pretty good sign. Normally, when you've got the PPO pointing straight down and you rally, normally you stop at the 20 and then you go lower. In this case, we went through. So that's a good sign when you go through. Didn't mean all the selling was over. You can see things got a little testy here over the next week or two on this pullback, but then eventually we made that breakout through the neckline and we never went back to revisit those lows. So kind of where we are right now is similar to where we were back, say, in the second week of March, where we're trying to rally off what could be the inverse head. The other thing, and let me clear these. The other thing potentially that maybe you might see is something like this. I don't know, maybe we come back over here and we get, a little bit more of a rounded bottom here and put in a cup into October, pull back a little bit, handle, and then blast off in November, which has been the strongest month for the S&P 500 over the last decade, certainly within this secular bull market. So those are just a couple things I'd be looking for as we go forward. Now, you got to understand, if you're new to earnings beats and new to the show here, Trading Places, I am bullish. My long-term view is very bullish. And if you want to know why, I'll show you why. This is the 100-year chart. Now, if you want a long-term chart, this is how you get a long-term chart, 100 years. When you look at this, we go through secular periods or long-term periods. Forget about the short-term 10% pullback, even the 20% cyclical bear market. You get those. That was one of the things I was talking about when we had the big drop during the pandemic, that it was a financial crisis, or it was a healthcare crisis, not a financial crisis. And we came right back out of it and moved to new highs. Very similar to what happened in the 1987 market crash. And the irony here is we were about the same stage of the secular bull market. Here, we were in about the 7th year. We broke out here in 2013, 7th year is 2020. That's when it happened. So it happened almost at the exact same time within the secular bull market. And then we just kept going higher, just like we did back after 1987. Kept moving higher. Remember, we had the Persian Gulf War. That was just a hiccup within the secular bull market. So the media keeps coming up with all these reasons why this bull market's going to end and why we just can't sustain it. I'm telling you, based on what I'm seeing, that we're still in the early innings of this long-term bull market. 12, maybe 10 more years, maybe 12 more years. I mean, we're in already for about 8 years. And if you look back at these periods, when you make these double top breakouts, we tend to go up for about 20 years. So we made this double top breakout in 2013. The other thing that I don't understand why more people don't talk about it is, where else are you going to put your money? You're going to put your money in a 1.5% 10-year Treasury yield? You're going to put your money in gold, which has been going down relative to the S&P 500 for 8 years, 10 years on a relative basis? Where are you going to put your money? These cycles, these are long-term cycles where different asset classes are in favor. Stock market was not in favor for 12 or 13 years. You could have done better in a lot of areas rather than being in US stocks. But when you come to an end, I mean, we grew over those 12 or 13 years. The economy overall grew, but the S&P had a lot of catching up to do, and that's what we're in the midst of right now. So when I look at the stock market, I'm thinking long-term strength. So when we get pullbacks, I'm not thinking run for the hills. I'm thinking, all right, this is an opportunity to get into some of my favorite stocks cheaper. Now, could I be wrong? Sure. There's no guarantee that this next 12 years is going to be what we saw back in the 80s, 90s, or even the 50s and 60s. But I think history is a guide, and it makes sense to me. Why would the S&P 500 go nowhere for 12 years? I mean, I know we had the financial crisis. I know we had the dot-com bubble, but overall, we did have growth during those 12 years, yet the S&P 500 didn't reflect that. So the other thing that's pretty important on this chart is as we broke out, this was April 10th, 2013, when we got this double top breakout, and we haven't looked back. This move to the upside has been led by technology. The XLK during this period has risen 477%. Now that was as of, I don't know, maybe a week ago. I don't remember when I did these calculations, maybe a couple weeks ago. But the XLK easily the leader. Communication services next at 324%. XLY next, that's consumer discretionary, 287%. Go all the way down here, S&P 179%. So if you want to outperform the S&P 500 in a secular bull market, you've got to be thinking about these aggressive areas. Do they present more risk if you're wrong and the market goes down? Absolutely. But that's why we watch relative strength on these groups. And outside of recent weakness on the communication services group, which, to be honest, they're entitled to after leading for a while. You're not going to lead all the time. You're going to have rotation. I think everything in this, all five of these aggressive groups, industrials, financials, consumer discretionary, communication services, and technology, in my opinion, they all look good long-term on a relative basis. So I'm not seeing anything yet that's telling me that the bull market's coming to an end. I mean, when we hit the top back here in 2007, consumer staples was outperforming consumer discretionary, and consumer staples was at a 5-year relative high to consumer discretionary when we topped. It's the exact opposite right now. Wall Street has a pretty good sense. It's a pretty smart group. They have a good sense of when we're going to take a much bigger hit. And so you got to watch for some of those below the surface signs. And that's why I do a lot of this long-term analysis. It's why I do a lot of the relative strength work, the intermarket relationships, looking at transports versus utilities, looking at small caps versus large caps, looking at consumer discretionary versus consumer staples, and so forth and so on. The reason we do that isn't just because I want to look at another chart. It's because I'm trying to determine the sustainability of the bull market that we're in. And I don't see signs that this bull market is over. So I tune out everything I see and hear on internet, media, all of that, because most of what you're hearing are opinions, not facts. And there's also an agenda you got to be careful about. You know, I mean, if the market's going to go up for the next 12 years and I'm Goldman Sachs, I'd love to get prices a little cheaper. So you got their analysts going on CNBC, and I'm not saying anything's intentional. I have no idea, couldn't possibly know, and not making accusations. It's just when you've got a conflict of interest, which there are tons of those in the market right now, you got Goldman Sachs that's a market maker. So they're buying and selling shares every day. They're providing liquidity in the market. They also have analysts that go on CNBC and talk about whether to buy or sell stocks. They manage money for folks like you and me. There's no conflict of interest in all of this. Of course there is. Market makers, in my opinion, should be independent, but that's just my opinion. As long as they're still tied to financial firms and there's billions and billions of dollars in the market to be won or lost every hour, every day, every week, every month, every year, you got to be a little suspicious. So anyway, I'm ignoring the media. I'm looking long-term in a bull market, short-term, I'm looking at entry points when we weaken. And so that was the point of that whole discussion. I want to talk a little bit about earnings because I got a few earnings reports out here. Haven't seen the whole reports. I haven't seen revenues, but did see the earnings per share. So let's talk about a couple of these. First, JP Morgan. JP Morgan currently is flat. So they came out, they beat 374 versus $3. Look at the pre-earnings run. This is the problem when earnings come out. Just because you have great earnings doesn't mean you're going to go up. And a lot of folks following the market just don't understand that. If you don't follow the market closely and you see headlines, JP Morgan blows out, record earnings, whatever, and then you look and the stock's down a penny, you just scratch your head. How can that be? Well, Wall Street's already been out meeting with JP Morgan for many weeks, up until the end of their quarter. Of course, since their end of their quarter, it's a quiet period. They're not allowed to. But prior to the end of their quarter, they were out meeting with JP Morgan. They know essentially what JP Morgan's going to report. They know whether the stock is, adequately valued or whether it's undervalued or overvalued. And in this case, they liked what they saw and they were buying the stock into its earnings report. Buy on rumor, sell on news. You probably heard that plenty of times. Well, it's a true statement and it happens a lot in the stock market. So you can have great news, but a lot of times it's already priced in. So many times you'll get this pullback. So that's why I was saying earlier, we need to watch bank earnings and reactions to see whether or not the market has adequately valued these companies. Because if they haven't, then we're likely to see many of them move higher throughout earnings season. But JP Morgan's going to be our little sample for today, the guinea pig, if you will. Another bank that reported FRC. Let's see what's going on here. This is First Republic Bank of San Francisco. This one's up 2.25% with its earnings, $1.91 versus $1.83. And if we pull the chart up on FRC and go to our relative charts so that we can see on a relative basis, you can see this one relative to the banks. It actually pulled back a little bit, still holding on above where it was. But honestly, I would not have been expecting probably as much out of FRC as I was JP Morgan. If we look at JP Morgan on a relative basis, I think JP Morgan, you can see, has been in a little bit more of an uptrend. Trying to think, Bank of America is one that we'll be reporting later in the week. Look at the Bank of America relative strength versus the banks. It's up near a 52-week high. So this is a stock that I would expect to come out with solid results. But again, is it going to be a solid reaction? That's the part that's literally almost a coin toss. But when I see a stock that is performing well on a relative basis and they come out and they beat and they pull back with that good news, I'm usually looking to enter in that during that period of selling. So it might be a buy on rumor. Maybe Bank of America comes down a little bit, reports great earnings. That movement back to the downside would be an opportunity, in my opinion. A couple of other companies that reported. Let's take a look and see how they're reacting. First one is an asset manager group, Blackrock. And Blackrock had been downtrending for quite a while. Stock, though, getting a positive reaction here. This could be although they did beat, I don't know what they did on their revenues, but bottom line, they beat $10.95 versus $9.54. So $10.95 versus $9.54. Stock been in a downtrend, though, looking to come back up to about $8.63, which is right up here near that 20-day. I'm going to be interested to see, do we have a hollow candle and move up throughout the day after the gap up, or do we go right back down below the 20? That's going to be a key. Last one I'll show you here is Delta Airlines, which reported this morning 30 cents versus 15 cents. So a doubling of what was expected. Stock's been moving up, though, into its earnings, down 2% here in pre-market. All right, I'm going to take a look at the 3 most active stocks yesterday as your 3 you must see. And so we are going to start with Ford. Ford, I talked about yesterday, by the way, during Max Payne, a ton of in the money calls right now on this stock. So be careful as it gets up close to this high in June. It may struggle to get through, but it is poised perhaps to get up to that level based on the way the chart looks. Just be careful. Option expiration Friday. AT&T was the second most active, breaking back down after a down move, bear flag. I don't know. This one does not look good to me at all. I've not been a fan of AT&T. I can't even tell you the last time I talked about AT&T bullishly. And then Apple was third. Now, Apple's been pulling back. There's some supply chain issues. We'll see what happens when they report coming up soon. But in a downtrend, stock needs to get back through its 20-day. That's the key. All right, that's it for me. I appreciate you tuning in. We did just open up the market. I'm trying to get these shows done just before the market opens, but a few seconds late here. We can see the NASDAQ currently up 71 points, S&P up 9, and the Dow Jones up 15. So we are getting off to a good start. Let me just give you one quick look at JP Morgan because I'm interested myself to see what it's doing. It is down about 1/3 of 1%. All right, I'll be back tomorrow over at Stock Charts TV at 9 a.m. for your next Trading Places Live. All you have to do is go in here to Stock Charts TV, click on it right around 9 o'clock. The show will come up and you can check it out. I'd love to have you over there as well. And remember again, Chart Fest 2021 is this Saturday, 11 a.m. Eastern, but you can get a recording if you can't attend live. The way you do all that, go over to Earnings Beats, scroll down, look for subscribe to the free Earnings Beats Digest. Name and email address. That's basically all you have to do to register for this event on Saturday. Everybody have a great day. Be back tomorrow. Happy trading.